Welcome to episode 11 of AltFinance, the funding frontier, your guide to the cutting-edge world of alternative financing. I'm Jason Feimster, founder and CEO of Moonshine Capital, and today we're venturing into a topic that's stirring conversations in entrepreneurial circles: credit card stacking, revolutionary funding, or risky business. In this episode, we're set to unravel the mysteries of credit card stacking. Is it the key to unlocking new levels of financial freedom for business, or a precarious path paved with pitfalls? We'll explore every angle, from its mechanics and historical roots to real-life success stories and the potential risk involved. Credit card stacking isn't just about having a wallet full of cards. It's a nuanced strategy where business harness the collective power of multiple credit lines. But how did this strategy come into play, and how does it differ from everyday credit card usage? These are some of the questions we'll answer as we delve into the world of credit card stacking. So whether you're an entrepreneur looking for innovative funding solutions, a small business owner navigating the complex world of finance, or simply a finance enthusiast eager to learn more about the latest trends, this episode is for you. Join me as we dissect this fascinating topic, offering insights, expert opinions, and much more. Get ready to have your perceptions challenged and your knowledge expanded. AltFinance, the funding frontier. Let's dive in. Credit card stacking, a term often shrouded in misconceptions. It's time we truly understand what it is, how it came to be, and how it differs from conventional credit card use. Credit card stacking is not just about owning multiple credit cards. It's a strategic approach where individuals, particularly entrepreneurs and business owners, acquire several credit cards. They then aggregate the credit limits of these cards to secure a substantial sum of money. This sum, often much larger than what one could obtain from a single card or a standard business loan, can be pivotal in funding business operations or significant investments. Historically, credit card stacking emerged as a response to the rigid and often inaccessible traditional banking systems, especially for small businesses and startups. In the early 2000s, as banks and credit card issuers were expanding their customer base, some astute business owners recognized an opportunity. By combining credit limits from various cards, they could access capital that would otherwise be unattainable, given the stringent lending criteria of most banks. This method represents a significant shift from traditional credit card usage, which is typically aligned with personal expense or minus business purchases. In credit card stacking, the focus is on leveraging credit for substantial business investments, be it for purchasing inventory, funding a marketing campaign, or even covering operational costs during a cash flow crunch. Let's put this into perspective with a real-world example. Imagine a small but growing online retail business. To keep up with increasing orders, the owner needs to invest in more inventory and perhaps upgrade their logistics software. Traditional loans might be out of reach due to the lack of collateral or a long-standing financial history. Here, credit card stacking comes into play. By strategically using multiple credit cards, the business can immediately invest in these crucial areas, ensuring that growth isn't stifled by a lack of funds. But it's not just about access to capital, it's also about the speed. In the fast paced world of business, opportunities don't wait. Credit card stacking offers a rapid solution to capital needs, unlike the often lengthy process of securing a traditional loan. As we delve deeper into this topic, it's crucial to acknowledge the innovative spirit that birthed credit card stacking. It's a testament to the resourcefulness of entrepreneurs in finding solutions to financial barriers. Credit card stacking emerged not just as a financial strategy, but as a paradigm shift in thinking about business funding. Having understood the basics of credit card stacking, let's dive into what makes it so appealing, especially to entrepreneurs and small business owners. This segment will illuminate the benefits and real-life success of credit card stacking, showcasing why it's considered a revolutionary approach to business funding. The primary allure of credit card stacking lies in its unparalleled accessibility and flexibility, crucial factors for emerging businesses. Traditional funding routes, such as bank loans or venture capital, often come with a labyrinth of requirements and restrictions. These can be daunting, if not outright prohibitive, for new and small scale entrepreneurs. Credit card stacking, on the other hand, offers a more attainable and adaptable funding option. Consider the story of a tech startup in Austin, Texas. The founders, fresh with innovative ideas but limited in capital, turned to credit card stacking to kickstart their venture. By strategically utilizing the combined credit limits of several cards, they managed to fund their initial software development and marketing efforts. This crucial early stage funding, hard to secure from traditional sources due to their lack of history and collateral, was pivotal in bringing their ideas to fruition. Another compelling aspect of credit card stacking is the control it offers. Business owners can decide exactly how much to borrow and when to use the funds, aligning closely with their company's cash flow and investment needs. This granular level of control is seldom possible with conventional loans, where the capital is received in a lump sum and often comes with a rigid repayment schedule. Credit card stacking also opens doors to opportunities that require immediate capital injection. For instance, a boutique in Miami was presented with a time sensitive opportunity to purchase inventory at a substantial discount. The owner, utilizing credit card stacking, quickly assessed the required funds and capitalized on this opportunity, leading to a significant increase in profit margins. But it's not just small businesses that benefit. Even established companies find credit card stacking advantageous for certain situations. A well known restaurant chain, for example, used credit card stacking to fund a rapid expansion of their delivery services in response to the increased demand during the COVID-19 pandemic. This agility in financial decision making can often be the difference between seizing an opportunity and missing out. These success stories of credit card stacking are numerous, each highlighting how this strategy can be a game changer for businesses in various industries. By providing quick, accessible, and flexible funding, credit card stacking empowers entrepreneurs to capitalize on opportunities, overcome cash flow challenges, and drive growth. While credit card stacking offers numerous benefits, it's crucial to address the risk and pitfalls associated with this strategy. In this segment, we'll explore the potential downsides, illustrate them with real life examples, and provide insights on how to mitigate these risks. The most prominent risk of credit card stacking is the potential accumulation of high interest debt. Credit cards typically have higher interest rates compared to traditional loans. When multiple cards are stacked, the compounded interest can escalate the overall debt burden significantly. This can be a double edged sword. While access to immediate capital is a boon, the accruing interest can become a significant liability if not managed carefully. Consider the case of a retail store in Chicago. The owner, enticed by the ease of accessing funds through credit card stacking, financed an ambitious expansion plan. Unfortunately, due to the unforeseen market changes and lower than expected sales, the business struggled to meet the high monthly payments resulting from the stacked credit cards. The mounting interest quickly turned the initial financial advantages into a crippling debt. Another pitfall is the potential impact on credit scores. Credit utilization, the ratio of your credit card balances to their limits, is a key factor in determining credit scores. High utilization, which can easily occur with credit card stacking, may lead to a decrease in credit scores. This, in turn, can affect future borrowing capacity and terms. There's also the risk of over reliance on credit card stacking as a financial strategy. Businesses might resort to stacking cards as a quick fix for cash flow problems, ignoring underlying issues like inefficient operations or poor market strategy. This over reliance can create a cycle of debt that's hard to break and distract from addressing fundamental business challenges. To mitigate these risks, it's crucial to have a robust financial strategy in place. This includes strategic borrowing. Only use credit card stacking for specific, strategic purposes and avoid using it for ongoing operational expenses unless absolutely necessary. Budget management. Have a clear plan for how the borrowed funds will be used and a realistic projection of the returns on this investment. Debt monitoring. Regularly monitor the debt levels and have a clear repayment plan. Aim to pay off the balances as soon as possible to avoid spiraling interest costs. Seeking professional advice. Consult with financial advisors to understand the implications of credit card stacking for your specific business context. In summary, while credit card stacking can be a powerful tool for business financing, it requires careful consideration and disciplined financial management. As we navigate the complex world of business financing, it's essential to understand how credit card stacking compares to other available options. In this segment, we'll just expose credit card stacking with traditional loans, venture capital, and financing methods to provide a clearer picture of its place in the financial landscape. Firstly, let's consider traditional bank loans. Bank loans often offer lower interest rates compared to credit cards and can provide a substantial lump sum of money. They are typically suitable for large, one-time investments. However, the application process can be lengthy and requires extensive documentation, including business plans, financial statements, and collateral. This can be a significant barrier for new or small businesses without a strong financial track record. In contrast, credit card stacking provides quicker access to funds and less rigorous application process. However, the trade-off is higher interest rates and the potential impact on credit scores. This makes credit card stacking more suitable for short-term financing needs or situations where rapid access to capital is crucial. Venture capital is another popular financing option, especially for high-growth startups. It involves selling a portion of your business to investors in exchange for capital. This can be an excellent way to raise significant funds without the burden of debt. However, it also means relinquishing some control and potential future profits. Additionally, securing venture capital can be highly competitive and often requires a business model with a high growth potential. Comparatively, credit card stacking doesn't dilute ownership and can be a more accessible route for businesses that may not fit the typical profile for venture capital investments. It allows entrepreneurs to maintain full control over their business decisions. Crowdfunding and microloans are another alternative worth mentioning. Crowdfunding allows for businesses to raise small amounts of money from a large number of people, typically via the internet. It's a great way to test market demand and build a community around your product or service. Microloans, offered by various nonprofit organizations and microfinance institutions, are typically smaller than traditional loans and are designed to help small businesses and entrepreneurs who might not qualify for bank loans. Each of these options has its unique characteristics and suitability depending on the business's needs, stage, and goals. While credit card stacking offers flexibility and rapid access, it comes with the cost of higher interest rates and potential credit score impact. Bank loans provide stability and lower rates, but require a more rigorous application process and often collateral. Venture capital offers significant funding without debt, but at the cost of equity and control. In conclusion, credit card stacking is a valuable tool in the arsenal of business financing options, particularly suited for specific scenarios requiring quick access to funds. However, it's important to weigh it against other available options, considering the long term implications for your business. As we continue our journey through the realm of credit card stacking, it's crucial to understand the legal and financial landscape that surrounds this strategy. In this segment, we'll delve into the legalities, compliance issues, and the impact on financial health, providing insights from experts on how to navigate these aspects responsibly. When engaging in credit card stacking, the first legal consideration is compliance with the terms and conditions set by credit card issuers. It's important to be aware that using personal credit cards for business purposes might breach these terms. Some issuers have specific policies against this practice, which could lead to potential complications, including the cancellation of your cards and damaging your credit score. Another key aspect is understanding the implications of the Credit Card Act of 2009. This act primarily protects consumer credit cards and doesn't extend the same level of protection to business credit cards. For instance, business credit cards can have higher fees and interest rates, and issuers can change these terms with less notice than required for personal cards. Therefore, it's crucial to thoroughly understand the terms and conditions of each card in your stack. Let's talk about the impact on credit scores. Credit utilization is a significant factor in credit scoring models. High balances relative to your credit limits across all cards can negatively impact your credit score. This is particularly important to consider as a lower credit score can affect future borrowing capacity and terms. From a financial health perspective, it's essential to have a strategic approach to manage the debt incurred from credit card stacking. Financial advisors often recommend having a clear repayment plan in place. This includes understanding the interest rates on each card, prioritizing repayments on the higher interest rate cards, and avoiding minimum payments only, as this can significantly increase the total amount paid due to compound interest. Moreover, it's advisable to regularly review your credit card stacking strategy. This includes monitoring your business's financial performance and adjusting your credit usage accordingly. In situations where business income isn't sufficient to cover credit card payments, it's important to seek alternatives such as restructuring the debt, consulting with financial advisors, or exploring other financing options. In summary, while credit card stacking can be a powerful financial tool for businesses, it requires careful and informed management to avoid legal pitfalls and adverse financial outcomes. Understanding and adhering to the terms and conditions of credit cards, managing credit card utilization effectively, and having a solid repayment strategy are key to successfully navigating the legal and financial landscape of credit card stacking. As we approach the conclusion of our deep dive into credit card stacking, let's turn our gaze towards the future. This financial segment will explore emerging trends, technological advancements, and what the future might hold for credit card stacking as a financing strategy. The landscape of business financing is continuously evolving, and credit card stacking is no exception. One of the key trends we are witnessing is the increasing integration of technology in finance, known as fintech. This integration is making credit card management more efficient and transparent. We're seeing the development of sophisticated financial tools and apps that allow business owners to track their credit card usage, manage their repayments, and optimize their credit utilization in real time. These advancements are making credit card stacking a more manageable and less risky strategy for entrepreneurs. Another trend to watch is the growing awareness and regulatory focus on lending practices. As more businesses adopt alternative financing methods like credit card stacking, regulatory bodies are taking notice. We might see more guidelines and regulations being introduced to ensure fair practices and to protect both lenders and borrowers. This could lead to more transparency and possibly more innovative credit products designed specifically for business stacking. Moreover, the future of credit card stacking is likely to be influenced by the broader economic environment. Factors such as interest rates, lending policies, and economic cycles will play a significant role in the shaping of how and when entrepreneurs use credit card stacking. For instance, in a low interest rate environment, credit card stacking might become more attractive compared to other financing options. Additionally, the continued growth of the gig economy and small businesses, particularly in the digital and e-commerce sectors, could drive the demand for flexible financing options like credit card stacking. As these businesses often require quick access to funds for short-term needs or to capitalize on immediate opportunities, credit card stacking could be seen as an optimal solution. However, it's also important to consider the potential challenges. The sustainability of credit card stacking as a financial strategy will depend on how well entrepreneurs can manage the associated risk, particularly the risk of accruing high interest debt. The future might bring more educational resources and advisory services focused on helping business owners use credit card stacking wisely and responsibly. In conclusion, the future of credit card stacking is poised to be dynamic, influenced by technological advancements, regulatory changes, and economic factors. As it continues to evolve, it will remain an important tool in the arsenal of business financing strategies, offering flexibility and accessibility to entrepreneurs ready to navigate its complexities. As we conclude today's episode on credit card stacking, let's recap the key points we've covered. We've delved into what credit card stacking is, its emergence as a strategic financing tool, and how it differs from traditional credit card use. We explored the benefits and success stories, weighed them against the risk and pitfalls, and compared credit card stacking with other financing options. We navigated the legal and financial landscape surrounding this strategy and speculated on its future in a rapidly evolving world of business finance. Whether credit card stacking is revolutionary funding or risky business, the answer lies in how effectively it's managed. As with any financial strategy, knowledge, prudence, and adaptability are key. For those who tread carefully, credit card stacking can be a potent tool in achieving business goals. Thank you for tuning in to AltFinance, the funding frontier. I'm Jason Feimster, reminding you to stay informed, stay savvy, and stay ahead in the world of alternative finance. Until next time, keep pushing the boundaries of your financial possibilities.